Hey traders, this is Blake Morrow with Traders Summit, and it's been about a month, and I'm so excited when I have these two gentlemen joining me on the Traders Summit, and I have Mr. Michael Brown from Pepperstone, and I have Mr. Dick Matthews from One.io, a crypto firm. Let's just call it a crypto firm. Gentlemen, welcome.
Hello, mate. How are we? It's been a while.
It has been a while. Richard, how are you?
Yeah, I'm good. I'm very, very, very good.
Well, it's good. It's good to see you guys. So before we even go anywhere, I have to say this just because I think about it all the time, and I have been over the last couple of weeks. Richard, well, first of all, happy birthday to you.
Thank you.
37 again?
37? Yeah. I think the Cockney slang is
Double
on
it.
a mouthful today, but I don't think any Americans will get that. But
well, hey, I want to say happy birthday, but more importantly, congratulations. I say this because I have been thinking about you as, you've seen some of these big banks shift from all these rate cuts coming in 2024. There's actually a couple banks that are now thinking that a rate hike might be the next step for, whether it's the Fed or, majority of central banks. Let me ask you this. Why at the time you were so hesitant about the Fed cutting rates, and you were and these expectations you felt were just so exaggerated, and this is going back like the last couple of months. So what made you stick to that call?
it actually goes back a little bit to the last time we spoke. You were saying, "Oh, is US exceptionalism coming back?" And I actually took the view that it's never gone away. I think that the economies I get boring about this is exceptional. I don't think inflation is necessarily dead there. I think employment looks good. I can't see why you would want to cut rates.
Yeah, I mean,
There's no need. There's absolutely no call for it. And I think it's probably a 50-50 whether you hike rates or cut rates. Looking at employment, as I'm just saying, is good. Policy's pretty easy. Stock market's roaring. That's great for everyone. Everyone feels rich again. I still think there's a good case to argue for a hike in rates. However, we have got PC. Shut up, Michael. We have got PCE coming up this week, and that could well set the tone for it.
yeah, and so let's ask Michael, where do you stand on the rate conversation? Because, like I said, there's been such a big shift. I think unanimously we came into this year believing it seemed a little exaggerated, but did you expect the pendulum to swing this far the other direction?
To be honest, I'm not sure it has swung. I mean, it has swung in the other direction, yeah, but I don't think it's been perhaps as extreme a move as everyone is making out. I mean, you look at the OAS curve now for the US. When I left the desk, 5 minutes ago, it was pricing about 80, 85 bips of cuts this year. I mean, that's only 10 more than the Fed have signaled in their dot plot. Clearly, it's a big move from where we were in January. But as you said, we all agreed that was overextended. I think the broader direction that policy will take this year has not changed. I think we're all still of the view that the next move is going to be lower. I think the consensus, and I know Dick is not part of this consensus, but I think consensus is that the battle against inflation has been won. 2% is going to be achieved at some point this year, probably in the second half of this year. Policymakers will get confidence that that's going to be achieved at some point in the second quarter, and at that point we embark on the easing cycle. And I think that's why you see equities remaining so resilient, because yes, although we've gone from 135 bips of cuts to 85, we're still going to get cuts. We're still going to get policy loosening. The backdrop is still supportive, and it's still an environment where, because they've now managed to restore price stability, central banks have the flexibility to deliver big cuts or deliver big liquidity injections or whatever it may be. That central bank put is back, it is alive, it is well, and that there's no real reason to sell risk as a result.
All right. Well, that leads me to like my next question at this point, because since the last time we spoke, stocks are back at all-time highs. Actually, I don't even know if they really left all-time highs the last time we all spoke, but we continue to grind higher. And it seems like at this point that the market doesn't care about anything really. It just, you could argue that the central banks have a Fed put somewhere where the Fed has a lot of room to move on rates. We have no recession coming from what it seems like as of right now. Employment continues to be strong. Inflation, even though sticky, it still suggests that there's a lot of economic activity. And you had so many bears at the end of throughout 2003, or so many people expecting a recession, that now you probably have a little bit of FOMO going on. Where do you guys stand with where we sit as far as risk goes? And I could say risk broadly, you know, whether you're talking about the US equity markets or Nikkei or DAX. And is there anything that really jumps out to you right now? And we'll start with you, Michael. Where do you stand on risk?
Well, I think you may have quite neatly answered the question for me there, mate. I mean, you've pretty much just listed 4 or 5 incredibly bullish catalysts and reasons why the market should continue to rally. I think it's more a case of the way that the stock market has navigated risks so far this year and navigated potential landmines suggests that actually the path of least resistance does continue to lead higher. I mean, as you mentioned, when we last spoke, we were at all-time highs. We then had a bit of a hotter than expected CPI report. We came 1% or 2 lower, dip bought rapidly and in size. We then move into the Nvidia earnings last week. Blowout earnings, semiconductors rally, chip makers rally, the whole market rallies, and that's now kicked off a kind of global risk-on move. I think unless we get anything to change what is currently the base case of rate cuts are coming, policy will normalize, the economy remains strong and on track for a soft landing, and inflation has been pretty much killed without needing to destroy the labor market to do it, equity should continue to move to the upside. If we get another couple of hot inflation numbers, or if we start to see unemployment tick higher, or a negative payrolls number, or another couple of months of relatively weak retail sales, that retail sales report in the US for December wasn't particularly pretty, and the January one wasn't great either, then you'd start to question the bull case for equities a little bit. But you've got an economy going gangbusters, liquidity coming back into the market, and policy easing on its way. I find it pretty tough to play equities from the short side in that environment.
So, Richard, how about yourself? I mean, do you feel that this is like the time you should still be long equities, or do you feel that maybe things are getting a little bit too out of hand?
Still be long. I'm not sure I'd want to buy. Put it that way. I think that, you know, you've seen such a strong rally. You know, is it FOMO or is it Tina or whatever? I think there's certainly Tina comes into play. But you know, where else do you put your money at the moment? I do think, however, there are 1 or 2 problems lurking on the horizon, and I know Michael's going to laugh when I say this. You know, the Houthis and what's going on in the Middle East, I think, is a worry. I think that we're going to continue striking at them. They don't seem to particularly care what we do. I think that could potentially have a black swan event. I think it's interesting about Nvidia is actually how many businesses do they put out of business eventually if their technology and A1 really works? How many components of the stock market are going to go pop? It's not a question for today, but actually I think it's something which people might start looking at. Okay, well, if that's a success, what happens to designers? What happens here? What happens there? And I think a lot of the money going to Nvidia will come out of other stocks because they could well become, well, they are a mega cap. And so I think that's one little worry I've got, what's beneath the market. But really, the market's being driven by 6, 7, 8 stocks at the moment. It's just a really odd market. My other worry, which I've been harping on about, is real estate, particularly in the commercial market. I think that looks really weak. So I think there are some little worries there, but at the moment, yeah, it wouldn't worry me enough to go short. I wouldn't be buying, as I said, but I wouldn't want to go short here.
That makes sense. Okay. Well, I want to touch on currencies a bit where we're at, because I think that the currency market's in a very interesting dilemma. And Michael, I told you ahead of us hitting record, I was going to harass you a little bit about the Kiwi. Now, for those of you that don't know this, Michael Brown does he hosts a show called The Trade-Off UK. He's with one of my partners, Ryan Littlestone from Forex Analytics. I myself do the Australia trade-off show with Chris Weston at Pepperstone. And we go back and forth between the two shows. So if you're in the UK or you're in Australia or you're anywhere for that matter, you should be watching the show. We cover a lot of ground and a lot of great stuff. Anyway, we were joking because I was looking for Kiwi short, and I've been short some Kiwi dollars. Michael, the same week, looked for the same thing, and the Kiwi didn't go down; it just kind of stopped. But I harassed him about it. But I also want to say this because I don't think it's Michael or anything. I think it's actually more equities. You got equities continue to rally. Typically speaking, like if you're trading currencies and you understand that stocks continue to go higher, typically you're going to sell dollars, deploy them elsewhere. You're going to be buying, New Zealand dollars, Australian dollars, everything else. And I would argue that that's probably one of the reasons why the Kiwi, I mean, there's a few reasons I think, but that's one of the reasons why the Kiwis kind of stabilized where we're at. But here we are, stocks are at all-time highs. Kiwi and other currencies, really, the dollar hasn't gone down as most people would expect. But more importantly, going back to the Kiwi, we have the RBNZ rate decision. We have Australia CPI coming up in less than or about 24 hours from now. Michael, how are you reading the currency market at this point?
Yeah, it is in an interesting spot. I mean, more broadly, I think the market's kind of taking a bit of a pause for breath over the last week or so. We had the first 6 weeks of 2023 were buy dollars and buy as much of them as you can. The dollar index rallied 4% or so up to that 105 figure, and that was relatively broad based, concentrated against lower yielders like the yen and the Swissy, but relatively broad based on the whole. And then we've just seen that kind of take a pause for breath, a bit of profit taking, and the dollar's come off the boil a little bit. I think that's more of a blip rather than the start of a big change in the direction of the greenback. I'm sure Dick will touch on that more in a second, but the US exceptionalism story for me continues to be the big dominant narrative, and I don't see any sign that that's going to change anytime soon. But to touch on the Kiwi dollar in particular, I think it's interesting because one of the reasons for the rally, and I'm sure someone can correct me if I've got this wrong, I think it was 8 or 9 straight days of gains for the Kiwi dollar, which is, a ridiculous momentum that it managed to build behind itself, was because the market has suddenly got this idea in its head, mainly spurred on by some local Kiwi banks, that the RBNZ are going to hike maybe once or twice more. Now, unless Dick is moonlighting as Adrian Orr, the governor of the Reserve Bank of New Zealand, I can't see that happening, to be quite honest with you. They've delivered a lot of tightening already. Yes, inflation's probably a bit high, and yes, inflation expectations are probably a bit high for their liking. But if you look at some of the activity data coming in from New Zealand, it's shocking. Retail sales in particular were down almost 2% in the last quarter of 2023. So I don't think there's much scope for more tightening from the RBNZ, and this is probably going to age terribly. But I think this is all a little bit of a buy the rumor, sell the fact trade going on here. And actually, given the activity decline that we're seeing, given obviously the long running issues we see with China, I'm struggling to be bullish on either of the Antipodeans at the moment, be that the Kiwi or the Aussie.
All right. And just before we go over to Richard, I want to say that I don't see the similarities, but maybe might be, maybe perhaps
30 years ago, maybe.
I would say, or on a good day would look more like Richard. But anyway, Richard, let's hear it from you. How do you feel about the currency market and where we stand right now? And thank you for that, Michael.
I still fundamentally like the dollar. I don't think it's going to really turn and fall out of bed until you get close to the Fed actually cutting, which obviously I don't think is for a very, very long time. The RBNZ actually is an interesting one, because if they did hike, that would not have set the cat amongst the pigeons. And I think you could really see some action then. I'd be surprised if they did, but if they do, you could see some action. But I'd stay long in the dollar. Sterling, I think, is, as always, an interesting basket case. We've got a lot of political problems going on over here, which can only get worse, in my opinion. The euro, as always, I don't particularly like, so I'd stay long in the dollar until exceptionalism stops. I can see no reason whatsoever to short it.
Okay, well, it sounds like, and this, I'm going to turn it over to Michael here real quick. What do you? It sounds like you're just pretty much bullish the dollar. But I want you to think about this before I let you go, Richard. I'm going to first give the question over to Michael. Michael, what do you see as like the best opportunity right now? Like if you're like looking around, you see stocks at all-time highs. Bitcoin, by the way, is challenging 53,000. We're above it right now. New highs, new trend highs, thanks to Richard at 1.io. But you got all the, you got everything happening. What do you see as the best opportunities right now, Michael? And then Richard, I'm going to come back to you for that question.
Well, give me all the easy questions, mate. Why don't you? Let's go across the board. I think long risk still, primarily US equities, but I also like Japan. I think Japan actually, for a longer term long position, is something that looks really appealing. Not only because the Nikkei's got momentum behind it, but also if you think about a lot of the corporate reforms that are going on in Japan, they are really focused on trying to improve shareholder returns. So I think that is going to push the market higher over the long term, that the structural changes there. And also the fact that, a lot of people are now saying, and I would agree with them, that China is an uninvestable market. If you want exposure to Asia, where's the next place you go? Naturally, it's Japan. So in the equity space, that's where I would be. In the FX space, long the dollar, probably against the lower yielders primarily, be that the euro, be that the Swissy, be that the yen. I don't think the Ministry of Finance are going to come in anytime soon. There's nothing really in the bond market that's overly appealing. I think the front end is probably going to be a buy if we had another 30, 40 basis points higher, if we start to overshoot where the Fed may cut to. But I think that's a bit of a long way off. I guess the one idea that I do have, and I know Dick is going to absolutely hate me for this, it's conditional on the ECB cutting early, i.e. probably by April, and probably cutting quite aggressively. But if they do, then I think the second half of the year, the euro could rebound a little bit if the ECB cutting early and earlier than their peers does manage to put a bit of a floor under Eurozone growth. I mean, economic activity is falling off a cliff. So if they can let up on the restriction a little bit, and that does support the economy, maybe the euro is going to come back in the second half of the year. But I think that's a long way off. I think, long US equity, long Japan equity, long the dollar, they're probably the three I would have at the moment.
Well, that's an interesting thought process, since we haven't been there in a while, where a currency is actually revered and cheered for, a growth idea that, they cut rates, but that's going to be better for growth. That's a good idea. And you're actually the first person that I've heard say that. So good on you. Richard,
let's see if I become a trendsetter, shall
we? Let's see. All right, Richard, how about you? Where do you stand?
ECB being cheered rather than jeered, I find that quite an extraordinary comment. I'm going to hold you. Although I do agree, I think the ECB will cut first. And I've said this for a long, long time, and I think they'll cut and run probably sooner than later. I'm not sure whether that will stimulate growth or not. I think that Europe's got so many problems, especially Germany's got so many inherent problems. I'm not sure I would actually agree with buying the euro on the back of a cut. I'd probably go the other way. I like Japan. I like the States, as I said earlier. So I'd want to be long with those two. Sterling, I don't know. I guess it will probably be second to cut. Although you've got 700,000 mortgages up for renewal this year, which people are going to really, really hurt. Still looking at an election. I still think that Sunak may be pushed out sooner rather than later. And if they do push him out in April, May, then you could get a very, very early election, which they'll get absolutely mullered in. So I wouldn't want to be long as sterling against anything, maybe just about against the euro if you push me to it. And Michael's going to hate me for saying this. I'd stay long at Bitcoin.
I was just going to ask, when's he going to throw that one out there? That zinger. Yeah. Just get long Bitcoin.
You got 584 billion went into the ETFs last week. It's a huge number. There's not that supply there. It's just going to squeeze and squeeze and squeeze. My inner voices in the market tell me that China's sitting on the price at the moment. And if they let it go, it could really, really rip. I'm not a great believer in this, but some of the younger generation are worried about the debasement of the dollar. How many? What was it? The
Sorry,
deficit grew?
not this member of the younger
that-
generation.
not that
Let me rush to clarify that one.
No, but I mean, what the US deficit grew by 250 billion last month. I mean, it's just a huge number. So I think there's that sort of thought process amongst the younger generation. So I would be, to sum up, long the dollar, long Bitcoin, long yen, and short sterling, short euros.
All right. Well, that's a good summation. So, gentlemen, I tell you, it's always a pleasure for me to have the both of you on, especially together, and to be able to joke around, have some laughs, but really, more importantly, great ideas in the markets. And if you all at home have enjoyed, listening to Richard and Michael, make sure you give them a thumbs up, subscribe to this channel so you don't miss any of our exclusive content here at Trader Summit. Michael, what's the best way to follow your work and what you do?
There's many ways. You can go to the Pepperstone website behind me. I've helpfully obscured the logo throughout the whole video, or LinkedIn, I'm on there, and Twitter as well, of course, Mr. M. Brown on there. So, plenty of ways to find out what I'm up to.
All right, Richard?
Well, so I haven't got a logo. The only logo I've got is on my hoodie. So this is one logo that you can go to, one.io. You're grateful that I'm not wearing it, I will say. Or you can follow me at Dickie Matthews on Twitter.
I have to say, you were in your hoodie the other day when we met, and you looked pretty sly for a fly guy or something. However that goes. Anyway, guys, I want to say I appreciate having you both here, and really good luck, and thanks for all the information. And everybody, make sure you give them a thumbs up, and I'll catch you probably in about a month, because that's when we tend to meet.
Definitely. Thanks as always,
Thanks,
Blake.
Blake. Cheers now. Bye-bye.
See ya.
Bye-bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.